All right, people, we are live and direct. Welcome to this Facebook Live of the Visionary Experience. Today, we have Mr. Marquez Fernandez of World Financial Group. We're going to be having some very in-depth, engaging, educational discussion today about generational wealth, various life insurance products, really where it's not boring. It's actually just very applicable to your life, and really having the overall discussion of, okay, what do we need to do to properly plan for our family's future and for our present financial situation. So how you doing, Marquez? Welcome to the
That's right.
program.
Thank you, Brandon. No, I'm feeling great today. I mean, it's a beautiful day outside.
Yes.
And just like you said, I love talking about financial concepts, but making it interesting. It's a boring concept for a lot of people, but when you can make it fun and interesting, man, it leaves a huge impact on people.
No, absolutely. And in fact, this kind of reminds me, I was looking at YouTube earlier, and there's MIT, up in the New England area, up in Boston. They have these free courses that you can actually look at online. And there was a professor, a math professor, but he was talking about how to manage your investment portfolio. And what he was telling the students was like, you know what? We've done a lot of math over the semester so far, but now we're going to apply it. We're going to make it dynamic. And you could see that the students were much more engaged, right?
Oh
And
yeah.
yeah, and I think with regards to insurance, if people have the proper understanding of it and the proper perspective of what it is, in terms of looking at it as an investment and not as a cost or something that's, again, dynamic and active in their lives and how important it
Mhm.
is versus something that can be boring and mundane, which I'm sure you'll share a lot about, that it changes the entire narrative.
Oh yeah, it changes everything.
Right.
Yeah.
So I like to just essentially dig in. So when you're sitting down with an individual, when you're sitting down with a family or a particular client, what do you do to initially just engage them and make sure that you guys are both on the same page with regards to talking about their current financial landscape and their future?
Right. So, I mean, first, it's really like learning about them. Everything I do is client centered. Like, I'm not just going to give out some brochures of like, hey, here's this product, here's that product. Like, no, I have to learn about the person. Like, if it's you, Brandon, I'm like, hey, I need to learn about you. Maybe,
Right.
maybe about your dog, really get into the,
Yep.
like, I need to
Mhm.
know everything about this individual.
Right.
After we, kind of build some rapport, I learn about them, they learn about me. Then I can kind of understand where their focus is, where they're trying to get to. Are they trying to build generational wealth? They have kids. They want to buy a house later on.
Mhm.
I call it a whole financial needs analysis.
Okay.
And then from that point, it's like, okay, I have a better understanding of what they're trying to do. Now I can say, hey, let's do this. This is how it'll look over the course of however many years. And this is how it could play out for also your kids, but not even just your kids, maybe for your grandkids as well. So really like client centered.
No, that makes perfect sense. And so I remember when I was younger, wow, I don't know, maybe 10, 12 years old, or maybe even sooner than that, growing up in Baltimore, I do remember there was one time I was like not that old, but a little bit of an older gentleman, had a suit, had a briefcase, came to our home. I remember
Uh-huh.
I remember him sitting in the dining room, I think with my grandmother, my mom or my grandfather, something like that at the time. And I just do remember that it was insurance related. And really for a long period of time, that was my perception of someone who sells insurance. They kind of have a mid-level suit on.
Yeah.
You got a
Got the top
briefcase.
hat. And
Yep. Hello, sir. Like,
yeah.
and they're coming there and they're just like throwing a bunch of papers and folders at you.
Right.
Not necessarily against them necessarily, but again, that was my perception, and that might be other people's perception in some form or fashion, right? Very just straight laced, stiff. This is what it is. How do you break that perception, and how do you reimagine and redefine that?
I mean, it really just starts with just like really educating people on what it is. So sometimes, I mean, the biggest misconception is, oh, life insurance is for when you die. Or some people, they don't even know that. They just, oh, what, they don't know the difference between health and life insurance because no one talks about it. You don't really learn these things in school, right? Whether it's insurance, credit, or whatever. So really, I start with the education process. I might have a crazy question. I'm like, hey, did you know you could buy real estate with life insurance? And then they're like, hold on, like, how do you connect life insurance to real estate? That doesn't even
Right.
make sense because there's so many like amazing things you can do with it. Like so many people don't know, like, hey, you can utilize life insurance while you're alive and it can grow money. You could take it out, borrow against it. You could buy assets. And then when I start talking about certain things like this, like, man, you could utilize this to buy a car, buy real estate. And then it's like, wow, like their whole perception changes. And then it's like, now I've broken through a little bit. Now we can just keep it going.
Okay. No, and that's and honestly, I'm not even sure if I even knew that you could, I know that there are certain like cash values, right, of
Right.
insurance and things of that nature. But for myself, I would definitely love to, of course, continue to learn more within this field. And I think there's lots of people who work in different areas of finances, who may not have the full breadth or don't know all of the nuances that go into various financial products, right?
Oh
In
yeah.
insurance. And I think it's great that people like you are out there educating and kind of breaking down some of those barriers and false perceptions of what's going on.
Oh, absolutely. Yeah, I think there's a lot of because like traditionally speaking, everyone financially or for retirement, they go right to the 401k, right?
Mm,
Oh,
mhm.
it's such a traditional way to do it just because hey, you work, your employer says here you go, you don't ask questions, sign the line, and it works out, good for a lot of people. But insurance, life insurance and utilizing it for financial concepts and to attain your goals is very foreign to a lot of people. Because I always say, the not like 90 some percent of people are actually failing towards retirement because
Mm.
they lack a pure financial education of every tool that they could utilize.
No, that's a fantastic point. And so, I think with given everything that's going on today, meaning like, within the geopolitical space, a lot of the uncertainty,
Hmm.
a lot of the imbalance that's taking place. We're on the tail end of this, pandemic, and people just want to be done with it, right? We just want to have our normal lives. We want to move forward, and you have issues of inflation. Like there's always constantly something that we're being fed, right, in one form or fashion that try to keep us on edge. And but here's my question to you, because you had mentioned generational wealth earlier, right? And Anton, if you could bring up that screen with regards to generational wealth, because we have to not only, if you are a parent or plan on becoming a parent or plan on maybe having some assets that you want to pass on to someone else, you have to think of the term, generational wealth, which has been, kind of cliche, but it's so necessary. And so what we have here on the screen is a general definition. And I'd like for us to go through this, Marquez. It says, at the top, what is generational wealth? Generational wealth refers to assets passed by one generation of a family to another. These assets can include stocks, bonds, and other investments, as well as real estate and family businesses. And it has a list here. We'll look at the top 8 items on this list as examples of how to build generational wealth. The first says invest in the stock market,
Hmm.
uh, invest in real estate. I'm all for that.
Oh yeah.
Build a business to pass down. I'm all for that. Ding, ding, ding. Take advantage of life insurance.
There we go.
Yeah, we're going to come right on back to that one. Investing your child's education. Fantastic. Teach
Hmm.
children. This is critical. Teach children about personal finance.
That's a huge
Create,
one.
yeah, create multiple streams of income. And Anton knows about that.
Yeah, I love it.
And one of the things that I've learned a long time ago, and I think I learned this specifically through the book by Robert Kiyosaki, Rich Dad, Poor Dad, is pay yourself first.
Oh yeah, I
And I
was just
think,
thinking of that.
yeah, and I think your man Grant Cardone with the 10x principle and everything is like, you got to pay yourself first, So I could hear him saying
Yeah.
that. So, and I am in 100% agreement with that. So let's walk down this. Give me some of your thoughts on this list of 8 things here with regards to building generational wealth.
Man, I mean, I agree on every single point here. Like stock market, real estate, build a bit, like all these different things um, are essential, really important. Especially you were just talking about inflation,
Mm,
and with like it's almost like we're revisiting the time from like the Great Depression. Like, hey, war, recession with inflation.
mhm,
A great way to beat that is multiple streams of income already. But the easiest way, in my opinion, to create generational wealth is number four, life insurance, because from that, you can build out all of the other seven. And here's my reason, because when I sit down with people through my financial needs analysis, the one of the first things I explain to them is you have to pay yourself first. And
mm,
that's the concept to really understand, because if you want to build generational wealth, you have to create an identity of somebody who builds generational wealth. Not just that end goal, but you have to start with the identity. So first, that is okay, what would someone who creates generational wealth do? One, they pay themselves first. Because so many times people, what they do is they pay their bills, they buy all the fancy, the nice stuff, the fun stuff, and
mhm.
then at the end they're like, man, I have no money to invest, I have no money to save. It's because they pay themselves last.
Mm,
So I immediately say, okay, pay yourself first. And paying yourself first could be uh, putting some money towards your life insurance. So now, check this out. If you have an index universal life plan, or an IUL, right? That part of it, the money goes towards life insurance. The other part is actually mirroring an index in the stock market. That ticks off the first box. But for some people, they don't like the risk of the stock market, right? It's just like, oh man, it's up and down, up and down. But here, even if the market goes down, your money is still going to actually increase. So it's protected by the actual company that the money is in, almost essentially like invested in. And also, from the same plan that you have, the same IUL, you can take out money, you can invest into real estate. Like here's a quick tidbit for you. I don't know if you knew
yes.
this, but I do run an Airbnb as well.
Okay.
Airbnb, like short-term rental, right? I do this with my wife, and it's going great. It's fantastic. I'm actually planning on getting another one in the future, or several more. I'm gonna withdraw some money or take a loan from the IUL that I have to then acquire more.
Got it.
And then as I build the cash flow, and also meanwhile, that's another stream of income, right? On top of my business. Boom, that's number seven. Now I can use that cash flowing assets to now, pay myself. I can pay myself first. I can pass that business down. That's number three, to my
Mhm.
children. And then it's like, man, we just keep going. And then we're pretty much gonna. I want to teach my kids to do the exact same thing. Teach them about my business personally. Airbnb, about assets. I actually gave my stepson the Rich Dad Poor Dad book
Mhm.
to read. I don't know if he read it, but I tell him concepts here and there, because
Right.
he's a teenager, so I try to get it through, get through to him. But
Sure.
but yeah, but all of these are so essential, man. That I think the easiest way to start is number four, though.
No,
Number eight, then four.
I mean, I would agree with you. These, they're a very important concepts, and thank you for explaining that clearly. And the thing is, as you know, I work in mortgages, and what I try to do, one of my main mantras, excuse me, is to make what is complicated simple, right?
Hmm.
What may seem daunting or scary, just to kind of completely take that away, and to speak to people in a language and in a way that they can understand. And then this way, they're very comfortable with the process, right? And
Yeah.
so when it comes to different insurance products, for example, like an indexed universal life policy, what would you do for the person where this is an ideal product for them, but maybe they've never heard of it, maybe they just don't have a complete understanding, and there's a little bit of hesitancy on their part to move forward because of their lack of understanding. What do you do to explain this to them and then help them feel comfortable with it?
Okay, so I go through and I show them the like historical data, like okay, how it's performed over the past like 20 years.
Mm-hmm.
I'll compare it to what they have already. So I think that's a big thing because if you go back to what they're comfortable with, it could be like the 401k, IRA, maybe they have term insurance. That's when doing the whole financial needs analysis is so important because then it's a whole educational process. So even though they may be completely foreign to it, like, oh, I never even heard about this, it's comforting when I can compare like an IUL to what they have currently, what type of insurance they have already, what type of investments they have currently, compare and contrast. And then of course at the end of the day, I can always give them, the generic pamphlets and brochures, but various companies offer it. And I think it's also comforting to know that all of these products are very closely vetted by the government. Like the IRS, they don't play around with
Right.
in anything. So the fact that the IRS has a special tax code meant for insurance products like the IUL, you can be comfortable knowing like, okay, this is it's a legitimate product. This is something that is
Mm-hmm.
is meant to, at the end of the day, protect you and your family.
Absolutely.
So then they can feel more comfortable that way.
Got it. And so for those who, okay, so there's the generic argument out there by certain groups who I'll not name who say, okay, well, wait a minute. An index universal life policy will cost me hundreds of dollars per month. So why not get a $30 or $40 a month, 20-year term policy and invest the difference? So how do you answer those people who have that type of criticism toward the index universal life policy?
Oh yeah, I mean, yeah, I love that argument of like, oh,
Mhm.
buy term, invest the difference, right? It's so popular, I think, with people who essentially sell IRAs,
Okay.
right? That a lot of people are like, hey, you can have tax advantages with IRA, so maybe only just invest a little bit for the term and for that protection, and then invest the difference in like an IRA or whatever. Now here's the thing. Did you know there's a limit on how much you can contribute to an IRA?
Yeah. What is it? Is it about 12 grand a year? Well, I'm not even sure what the number is.
Six.
Six. Okay.
So only about 500 a month, right? And you also know there's, of course, like stipulations on like taking it out early.
Sure.
You get the penalties for doing that. So I just compare and contrast, and then I also say, well, I'll come to the IUL. I'll be like, there's no penalties for like you can take it out whenever you want. Essentially, you can withdraw the money. There's no max. You could put in $100,000 a year into it if you want to. There I haven't really seen a maximum amount that you can do. As well as I always say, it's a way you're merging that whole strategy into just one product, as well as you can maximize that. Like you are overcoming the risk. So one, there's greater tax advantages by utilizing like the strategy I help people with.
Mhm.
Um, Two, there's no limits. There's no real limitations to what we're doing. And three, there's no expiration on the protection feature.
So
If you
what do you
do the
what do you mean by that?
term, as in if you do term, it's for a specific term. It could
Right.
be just a few years. It could be as long, I've seen, of like 30 years. But essentially, the older you get, the more expensive term will be, and a lot of people would just be like, oh, okay, forget it, like I'm not going to do that with term. So then they lose coverage. I've seen this personally with people in my family.
Hmm.
It's super cheap when they're young, they don't pay attention to it, or they have it through their job. Later on in life, they don't have it. And then it's like all of a sudden, that idea of generational wealth is almost gone because they don't have that protection feature. But with the IUL, it can be permanent. So that will be there no matter what. You get older, you can still pay the exact same. So, to summarize, I really compare and contrast each little thing to that whole, pay a
Right.
little bit, invest the difference. Yeah.
Yeah, and that makes perfect sense. And honestly, like, when it comes to insurance, like in particular, if you look at a term policy, I really do feel that the term life insurance is a bit misleading when it comes to that, because it's really death insurance, because you have a death benefit, right?
Yeah.
Which is then paid out to the beneficiaries upon the death of the person that has the coverage. Whereas policies like an index universal life policy, it could be a true life insurance policy, because please correct me if I'm wrong, but if after a certain period of time, right, you can definitely cash out the cash benefit of it, right? Um, and or if you happen to unfortunately pass away, then there is a death benefit that will go to your beneficiary, so you can take advantage of it after a period of time, after your principal and interest has accumulated, right,
Mm-hmm.
over a period of time. You can definitely take advantage of that, as well. So is that line of reasoning correct?
I mean, yeah, it's a fair argument. I mean, I would definitely say term is better than nothing.
Yeah.
So I don't like to completely put down term,
Okay. Yep.
but in terms of comparing term to a more permanent solution, I mean, I don't even think it's a true comparison, because, like you said, it's more so for when you die. Like, yes, there are some features of term that they can come with living benefits, like if you
Okay.
get diagnosed with a terminal or critical illness. But the definition of terminal is like you're gonna die soon, right? Same with critical, that could be like you have cancer. So versus, and those, they just accelerate the death benefit a little bit. But now with things like IULs, like you said, yes, they accumulate a cash value
Hmm.
that is greater than the amount of money that you put into it, meaning that it's grown interest that you can tap into. And in certain cases, you don't have to wait that long to tap into the money, because of special IRS codes. They you can max fund these, and to be able to withdraw or take loans out against the policy and use the money while you're alive. That's the biggest thing. And you might be asking me this later, but if you think about it, there's a lot of banks who have your money and they invest your money when you put it into a bank. And a lot of times banks invest it in life insurance because they know it's
Interesting.
safe and it's going to grow money. And then they give you back the 0.01% where they're getting
Right.
far greater returns.
Well, absolutely. Yeah, and that's, I think for a lot of people in the financial world, that's it's sad but common knowledge, right?
Hmm.
I think that, where you have, like, if you were to look back historically over the 80s, where interest rates were in the teens, right? But if you had
Hmm.
a certificate of deposit at a bank, you're getting back 15, 16% on your money. But at the same time, if you're buying a house, you're paying 15, 16% on your mortgage, which is like, what? you know,
Right,
but,
right.
and then over, a period of time, for various economic reasons, those numbers come down and they've increased dramatically. But you are exactly right, because there's just, I think these days, outside of the concepts that Dave Ramsey teaches in terms of the baby steps and having money that you want to put aside in savings, which I agree with. You do want to have money that is liquid, right?
Yeah.
Real fast. Let me get my hands on it. You do want to have a certain amount of money in reserve that's liquid, but outside of that, there's not a lot of reasons to have money in a depository, because you're not getting any interest on it at all. practically,
Exactly.
where the money can be used in a more dynamic fashion at some other place in the market,
Right.
for sure. Which kind of leads me to um, let's look at this. Let's look at this list. I think Anton still has it up on the screen, right? So,
Uh-huh.
it says here, teach your children about personal finance, right? And so, and I know the answer might be as soon as possible, but let's say, realistically, right? What would you recommend, for, let's say, someone who's graduating high school or going into a community college or going into a 4-year institution, or
Uh-huh.
maybe they're just kind of getting out and they're just starting, figuring out what their career is going to be, right?
Yeah.
They, what types of recommendations would you make for that individual?
I think, man, and even just personally reflecting on my experience, even though it was, I think, very different than most, I would really say save, but not even just save. It's not even just saving to save. It's creating the skill of saving, the
Okay.
discipline of saving.
Yes.
And I touched on this earlier, the identity of somebody who's going to be wealthy. Because a lot of people, their end goal is to have a lot of money, but they still have a broke person mindset.
Yes.
So it's like, oh, you might save $5,000, or your goal is to get a raise so you can make more money, and then immediately you make more money and then you spend it. So I would say, first thing, fresh out of college, you have your first job, adapt the identity of a wealthy person and always ask yourself, okay, what would a wealthy person do? The first thing is learn to save money. So save your money, create, um, like a emergency fund. You can be like,
Mhm.
you always want to make sure, hey, save up. Maybe it's nice to have 3, 6 months of your expenses. If you don't even know what that is, figure that out. Like, what are your monthly expenses? How much is that? Get 3 to 6 months. That can go in the bank and save, and you have a cushion, you have a safety net. Now you start establishing more of a steady flow of income. It's
Mhm.
like, okay, now I can kind of start to, invest. You don't want to invest money that you can't afford, right? So that I would say, kind of once you build that up, then I would say, hey, a nice idea is to, now maybe look into a type of like IUL, because especially when you're young, man, it'll completely take off. Like, I would say, well, read Rich Dad Poor Dad, understand compound interest, the power of compounding your money over time. So if you're younger and you have an IUL, it is gonna go crazy over time. You are gonna be able to use that for so many different aspects and asset building, wealth building, that a lot of other people, they don't have the same time to do it. So that's the first step. And then I would say, yes, invest in, some real estate. Maybe call Brandon, see how to get approved for a mortgage, and go that route. But yeah, so I mean, of course, as soon as possible is great, but learn the skill of saving, and then once you have that good safety net, then you can invest in different um, areas.
Fantastic. You brought up some great stuff. I just had to grab my notepad here real quick.
Yeah,
So
yeah, man.
let's talk about a couple of those things. So, whew, okay, so you talk about compound interest, and I'm gonna define compound interest for people. Okay,
Okay.
so there's the concept of compound interest is this: it works in two different ways. It can work for you, or it can actually work against you. Okay, so basically, what happens is this: if you have an investment, let's say of $100 into anything, okay, and you get let's say a 7% return on that money. So a 7% return means you are earning 7% on top of that $100. So every year you will earn $7. And so after the end of 1 year, you will have $107, right?
Hmm.
As you go into the following year and you earn that same 7%, you're now earning 7% on top of $107, right? And so now you're going to have 114. And so then you go into the next year, and then the next year, and then the next year. And then what happens is you have what's called the compounding effect, or it's almost like an exponential effect. Like when you learn in high school, you have what's called exponents, right? That
Yeah.
little number on the upper right hand corner, right? That's
Uh-huh.
exactly what happens because you're earning interest on top of principal, right? On top of interest, on top of principal, on top of interest, on top of principal, and you're building a mountain. And so
Yeah.
that's really the way to look at it. And it works the exact same way in the opposite for credit cards, right? Because if
That's right.
you have an APR of 19.99, 29.99, whatever 0.99, right? They're going to say on your purchases, well, guess what? You get yourself some nice gear. You spend $175 on some nice gear, and you got to pay 29.99% on that. That's going to be that's a charge on top of that.
Yeah. That's
They're
how people
betting
build up credit card debt.
that absolutely they're betting on the fact that you're going to make only the minimum payment, which is
Yeah.
not even going to cover the principal and the interest, not even
That's
close.
why they're like, here, take this money.
You can have it,
Yeah.
right? And then as Dave Ramsey said, that snowball builds up because that compound interest is now working against you.
That's right.
And so I think it's so important for people to understand that basic concept in a way that's in a way that they can, it's chewable for them, right? It's manageable for them to see, because like you said, it can work for you, for sure, if you end up saving. So we've been talking about the IUL quite a bit. Can you break it down, define what the IUL is, and how it works in the simplest terms that you can?
Simplest terms would be it is a flexible life insurance product, right? That is a cash value accumulating product. So you have, let's say you have a bucket, right? The money goes into the bucket. Now, part of the money goes for the life insurance protection.
Okay.
Other part of the money goes towards your index that you prefer. Could be like the S&P 500, right? Could be the global index. So now, over time, the both are growing, the death benefit and the cash that is growing, because it's based on the performance of that index. But
Mhm.
now, here's the thing: even if the index goes down in the stock market, that's not going to happen to your money. It's not directly correlated. So the company has a protection feature, or what they call a floor.
Okay.
So some companies, they have a 0% floor. Some, they have a 0.75% floor, meaning that even if the stock market goes down, your money's still increasing by 0.75%.
Got it.
And then over time, what can happen is, since it's flexible, you can choose to pay certain months or not. And you can say, hey, I'm going to take the cash value and it's going to cover this, right? So it's very flexible. Yeah, like you can see different indexes like the S&P 500, and it can be permanent. It can
Mhm.
last. Shoot, if you make it to 120 years old, you can still have it and pay the same planned amount, right? You can increase the amount you put in. You can decrease it or just not contribute anymore.
Right.
So it's an amazing feature that you can also withdraw the money and take loans against it without having to pay, taxes, or to pay, penalties on it. Because you're in mortgage, right? You
Yeah.
give somebody a loan, you don't pay taxes on loans,
Right.
right? You put
No.
money into the bank. If you take the money back out, you don't pay taxes on just like withdrawing your cash. So
Right.
those two features is exactly how you can have your money grow without paying taxes on it.
Well, let me ask you this, but do you pay, is there a capital gain tax? So over a period of time, you make money on it. Can the
No,
government say, oh, it's increased? And whatever that difference is, can they come after you for that?
no, because if you're withdrawing the cash, you're withdrawing the cash that you contributed to
Okay.
it. And then if you want to kind of like tap into the interest that's grown, you're really
Mhm.
just taking a loan out against your policy.
I see. That's a great point.
and
So
you
it's
don't pay taxes on loans.
no, no. I'm sure they would like
And
the tax loans, but they can't.
right. And here's the thing: people will be like, "Oh, but now I'm paying interest on the loan." But it's twofold. It's not necessarily true. So yes, there is. It could be like 2 to 3%. It depends on the company. But also, what happens is, depending on what type of loan, it gets put in a cash reserve that also grows interest. That could be also 2 to 3% that negates it completely. And at the end, you never have to pay it back, and whatever you know gets passed on to your beneficiary, whether that's a person or a trust, which is
Hmm.
a whole nother topic.
Okay.
um, they get the difference between any withdrawals or loans and the death benefit. So the death
That's
benefit will
fantastic.
always be higher. So that's how you can also be like, hey, I can take a loan out and just never have to pay it back. It'll just be subtracted from the death benefit.
Subtract it from the death benefit, right? That's a
Yeah.
fantastic point. That's a fantastic point. So you also brought up, a word a couple of times, which really intrigues me because I actually did some writing on this recently, and that word is identity. And I
Hmm.
really appreciate you bringing up that particular word because it's very important to me. And I think that people who have a wealth or a hustler's mindset, right? They have an identity, or someone who says, you know what, I am going to win, I am going to produce, right? I am going to whatever. Like that's their identity. That's who they are.
Yeah.
That's their character, and that's how they approach life. And it reminds me, Marquez, a lot of different books, honestly, that I've read about your identity. Like, for example, there's a book that just came out by a man named Donald Miller, who I follow pretty closely, and the book is called Hero on a Mission. And
Okay.
basically, his whole mantra and what he talks about is that every movie or every story has four different characters. You have a victim, you have a villain, you have
Hmm.
a hero, and you have a guide, right?
Mm.
And if you kind of think about like most action type movies, or like in particular, like if you look at, thank you, if you look at like Star
Oh,
Wars,
nice. Okay.
you have victims and you have the villain, Darth Vader, right? You have the
Right.
hero, and then you have the guide who is Yoda, right? You know,
Yeah.
but if you look at that, and he talks about that identity. What is your identity? Are you going to have
Yeah.
a victim mentality where, man, the man is trying to hold me down? Which man? Where's that man at?
Right. Right.
Trying to hold me down. You're going to have a villain mentality where you hate the world because of your lack of opportunity, right?
Hmm.
Um, are you going to have a hero mentality, a hero identity that I'm going to take control of my life, or as you're doing right now, the guide, because you're helping people to be the hero of their own story. And that's
Exactly.
exactly what we do also at Visionary Lending. So I definitely appreciate you using that word because it is integral and central to people having success, and really people being able to lay out the groundwork and pave the way, for themselves and for their future family members.
No, it really is, and I'm gonna have to look into that book, because now, as I can say, I've become a reader because the more books that I read, I can actually say like, yeah, I'm a reader now. I actually love learning more now than I did in school,
Right.
which is I think the irony of our society. But and the reason I brought that up is one of the books I'm reading now, Atomic Habits,
Yes, by James
talks
Clear.
about. Yes, yeah,
Yes.
I have it here.
Yeah. Yeah.
um, and I'm covering that topic in my team's training tonight, actually.
Fantastic.
But he talks about like of how a way to like. There's three types of behavior change,
Hmm.
which is like of course, or like results. There's like results driven, process driven, identity driven.
Hmm.
So if I'm talking about people like financially or building wealth, everyone wants to have money. That's the outcome, right? Yeah, I want to have money. I want to have wealth, generational wealth. Yeah, I want to. Now, what's the process of doing that? Your habits, right? But even before that, you have to adapt the identity of I am somebody who is going to provide generational wealth to my kids.
Mm.
And I'm like, hey, if you're going out shopping, you need to remind yourself, hey, what would somebody do who is going to provide generational wealth? Or are they going to buy all of these things and then not have money to invest for their kids? Or are they going to do the opposite? So
Right.
then I love what you said of being the Yoda. I could be the Yoda and guide these people of like adapting that identity first, of understanding like, hey, paying yourself first is something that a person who provides generational wealth does. And then I can guide them through the processes needed, like an IUL can be one of them, or another strategy. So then they can get the results that they want, to
Yeah.
really like start from that inner identity and go out.
No, absolutely. And I'm telling you, people need advocates like you. I mean, we talk constantly here at Visionary Land about about being advocates for people,
Mm-hmm.
right? Because when you're a guide and you're advocating for someone, you're not doing anything for them. What you actually are is you're helping them to discover it themselves, right?
Right.
You're helping them in that process of growth and transformation, and again of discovery themselves, right? And you're helping them to actually go into the whole new world of their own identity, finding out who they are, or better yet, who they can be.
Right.
And
Yeah. It's
so,
like a
and
coach.
that's a beautiful thing. But go ahead.
No, I was just saying, yeah, it's just like a coach. Like I've been involved in
Yes,
sports for so long, and it's like a coach bringing out a player's potential.
absolutely.
It's just like the coaches, they don't play on the field, right? They're the ones, they're trying to bring that inner talent, confidence, potential out of a player, so then they can go and perform on their own.
Yeah.
I feel it's that same sense of, hey, I'm coaching people through this process, or this thing we call life, so then the next generation of life can thrive and can prosper.
Hmm.
It's something that I take very seriously, because in a lot of our communities, especially, I mean especially in a lot of minority communities, it's
Hmm.
not taken as serious as I think. Or no, it is taken seriously. It's just not a lot of coaches out there,
Sure.
to
Right.
give that guidance, to give that education. So I definitely take pride, and you say you're from Baltimore,
Right.
I am too. So I've definitely seen it, firsthand.
Oh yeah. I mean, and anybody who knows me, there's some central things about my identity, and I'm not ashamed. I'm proud of where I grew up, and in retrospect and looking back at life, I'm like, wow, like people struggled where I was. Baltimore has some beautiful, very affluent areas,
Yeah,
amazing, but I wasn't born in one of them, but that's okay.
right. Yeah, same here.
It is what it is. But I saw that struggle, but I couldn't quite interpret it or filter it properly because it was my life. I was right in the middle of it, so I didn't really have another perspective, right? But having then going to undergraduate and then coming down to the DC area, living some life and looking back, it's like, wow, you know what? There's People work hard, number one, and people
Hmm.
struggle, and they want to support and take care of their families in various forms and fashions. And I highly respect that, whether it's in Baltimore or any other urban area or rural or suburban area. But you're absolutely right. It's one of my driving forces. It's part of my fuel that I use to help as many people who have been historically, economically and socially disadvantaged for many in many different facets. So it's like, you know what? Let me at least take my talent and multiply my talent and not bury it in the ground and be able to give to as many people as possible so that they would at least then multiply that and so on and so forth. So it's definitely encouraging to have people like you, especially within this financial realm and this financial area, right? Because you know it's an easy area really where people can start.
It is.
Truth be told, it's a heck of a lot easier than purchasing a home. If I'm going to be honest about it, because
It is.
it's way easier. So, what would you say to the person that just wants to start? Like, I just want to start. Like, I need to just, do something now and take those first steps. What would you say to them?
Uh, I man, if it's somebody that I was talking to like directly, I would just say, hey, let's just let's just meet.
Right.
I don't charge any money to meet with anybody.
Mhm.
I would be like, hey, let's just meet. Let's just talk about your situation. Let's
Right.
see where you're at financially. Let's see what you're trying to do. Okay, let's put these pieces in place. Because if they aren't ready, I'm not somebody who's going to force them ready. Like I'm in the game of helping people financially, not hurting them.
Right.
That doesn't do any good. But now, if it's somebody on the other end of this Facebook Live, they're just listening in. Who knows? They could be halfway across the country, right? I would say first, like we said, start with that identity. Self-analyze your actions. Like maybe look back at your previous month's transactions in your bank,
Mhm.
look to see where you spent the money, and then put that, like, write out your month's expenses and see where, like, how much more you spent than your expenses
Mm.
versus how much you're making. And then really look at your expenses and be like, okay, if I'm serious of getting on the right track, like, yes, you can still have fun. I don't want to be the person I'm not the person who's like, man, you can't afford a Starbucks coffee ever. You can't do, these little things. Uh, in excess, it's bad. Just like eating dessert or a soda, but in little increments, it's okay. But really, get your monthly expenses, have your income, and compare and contrast. You should have money left over.
Right.
It doesn't matter if you make 50,000, if you make 40,000. I think if you have an honest conversation with yourself, I think you should always have money left over. And some people will be like, "Whoa, things are so tough. Gas is increasing. This is increasing." That's more of a reason to pay yourself first.
Yes. Agreed.
Everything, all expenses are increasing except income. This is why it's like, hey, pay yourself first. Learn to save. Have your money where it's growing. Learn the power of compound interest. So yeah, those I would say the three steps. You know, have your monthly expenses
Mhm.
versus your income. Two, save. An emergency fund. That's
Mhm.
important. Three, start investing a little bit, and that could be in yourself, right? Investing could be in books,
Right.
to increase your knowledge, to have a business. But most importantly, if you have a family, you should have life insurance as
Yeah.
like the next thing to do. You have car insurance, you have homeowners insurance. Why don't you have life insurance?
No, absolutely. And let me click on this right here. Let me see if it's going to show live on the screen here. Yeah, it does. Right. So, it says here, why is generational wealth important? And it says, stated simply, people who inherit generational wealth have a significant financial advantage over those who don't, right? These
That's
people
right.
likely have the ability to avoid student loans and other types of costly debt, this, that, and the other. And it's so true. And I think, and I've talked about this extensively, especially within the housing field, because housing is generational wealth because of the equity that's been accumulated over time. And that's a part of why we do what we do, right? Because people of color have been disadvantaged for so long. Now we're so far, behind the curve. And in fact, there was just an article that came out that came out with CNN, and it talks about how African Americans, the percentage of home ownership is lower than it is now than it was a decade ago, right?
Right.
And like it's an absolute shame, because if you look at the percentage of home ownership amongst Latinos, it's like 50% or above, right? 50 Cent probably owns
Yeah.
mad houses, right? But 50% and higher. And, with whites or Caucasians, it's in the 70th percentile. And I think probably around the same for those of, East Asian origin. And it's like, it all goes back to that question or that word that you said before, Marquez, and it's about identity. And I mean, I just cannot and will not let that go, because I think we have to really look at, yes, thank you, Anton, for bringing that up. Like, what is your
Yeah.
identity, right? Is your identity going to be that I am going to build and I am going to have the discipline and I'm going to have the sacrifice and the selflessness so that we have something tangible going forward, right?
That's right.
Um, and I think in one of the previous podcasts I did a couple of weeks ago, we had a quote real wealth conversation, and I talked about appreciating assets versus depreciating assets. And
There we go.
life insurance is, of course, such a valuable appreciating asset, where you have many people who have put their identity, right, their self-esteem, within depreciating assets such as a car, right?
Right.
Riding the flyest whip, right? Having the freshest this, the best that, the societal stance. Those are and it's a lie, that people are consuming, and they're making that part of their identity, while you have the millionaire next door who may drive a halfway decent vehicle, but that family has multi-millions of dollars because of their financial discipline, as you've been talking about, and how they're
Right.
able to take care of their family. So I definitely really appreciate you sharing this. And so as we begin to end off here, Marquez, any final words that you would like to share with our audience? Anything that you really want to stick, any points that you really want to take for them to take with them?
Man, final thoughts is just make the decision to be wealthy. It's going to sound, really artificial, and a lot of people are like, oh, it's not that easy. But I think if enough books that you've read, I know you read a lot of books, Brandon. It's that it first comes with that choice of
Right.
I, I'm I'm going to become wealthy. You have to make that decision. As soon as you make that decision, all of a sudden, life insurance becomes important. Saving money, investing becomes important. Where if you put the idea in your head of I am going to be, like, let's just say you came from a place that didn't have enough money.
Mm-hmm.
If you think you're going to die in the same situations that your parents or grandparents did, then you're automatically never going to take any action that is going to create money from the get-go. So the first thing, my final point, make the decision of, like, I'm going to become wealthy. And we have this crazy thing that Anton was utilizing called the internet. You could find a million ways to make money, to create wealth, and
Mm-hmm.
then you can learn how from books and all these other things. So make the decision, to create wealth, and start consuming content from people that look like you that are becoming wealthy, because then it's easier to adapt that identity when you see people that look like you that are doing what you're trying to do. So, and last but not least,
Oh, please.
last but not least, understand that life insurance is not just for when you die. You can utilize it while you're alive, just like so many wealthy families have done. So definitely, thank you for having me on, Brandon. I had a lot of fun.
No,
Uh,
absolutely. And we will take one, lesson.
that's right.
We'll take a lesson from NASCAR, of all places. Okay. They teach NASCAR drivers to look and drive where they're going, where they're headed. Because if you're driving around a corner, if you're just looking straight ahead at that wall, even though you need to turn, if your eyes are not on where you need to go, you will hit that wall and you'll crash and be done. And I appreciate you sharing with us and teaching us that we have to keep our eyes on the prize, right? Because that will help to properly direct us and steer us where we need to go so that we don't crash and we stay on the course. So
Yeah,
listen,
and believe
everybody.
it.
Yeah, so thank you so much, Marquez, for being on this. This is a fantastic discussion. What we're going to do is we're going to put in the notes or in our YouTube page ways that you can get a hold of Marquez Fernandez. If you have any questions, you want to seek his financial advice and help. You know, he's a fantastic individual, a loving, caring, competent individual who really is focused on helping people reach their financial goals and dreams. So I highly recommend that you reach out to him as soon as possible. Look forward to maybe doing a part 2 of this. You know, thank you so much for your time.
That's right. Thank you, Brandon. And feel free, anyone, to reach out. I'd be more than willing to help.
All right, absolutely. All right, thank you, everybody. So this has been a fantastic episode of the Visionary Experience. We're on Facebook Live. I'll see if I can get persuade Anton to put this on our YouTube page, and we can have this lit item. So take care, everybody. Love you all. Peace out.
See you guys.